Hey everyone, hope you're having a good day. My name's Andy. The channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and/or financial topics. Let's dive in, take a look, see what's going on today. If you want to follow me, at _finance, and if you want to join our community, finding-value.com, where I dive deeper into all of these topics and subjects, looking for potential investment opportunities for everyone in the community. I just went over recently my strategy of how I invest, how I approach the markets, different sectors, and how I drill down and find the individual companies that I invest in. And it's uploaded onto the website if you'd like to see that. We do have a coupon code special going on. Special is the coupon code for a 50% discount on a monthly membership on the first month only, and a much larger discount on the yearly membership, where you can switch from a monthly to a yearly or sign up directly to the yearly. So coming on down, we've got cycle investment strategy. Typical pretty much sums up the latest sentiment. And I know somebody was talking about, do I look at sentiment charts? Not really. Sentiment is kind of baked into the cake of what ratios are. So a really cheap ratio can only be attained with crappy sentiment. And a lot of the times that sentiment is kind of already known. You don't need a chart to tell me. You can tell if there's fear in the market, and that's generally a sentiment um, marker, we'll call it. If there's fear, it has a really cheap ratio. They all kind of correlate with each other. And even if you're buying something, you want those to all correlate anyway. So even if sentiment is bad, you may not be wanting to purchase it necessarily, depending on what the technicals or the ratios look like. So you could have a big upward move. We're in massively overvalued territory and the sentiment is bad, let's say on the first major sell off the top. That wouldn't necessarily be a buying opportunity. So sentiment still needs the alignment of everything else. And it says, especially the oil sentiment, it's completely bombed out by the tariff chaos. We see it as a great opportunity to build positions in the sector now to be positioned for the long term West Texas Intermediate cycle here. But I do agree with this here. The sentiment is bombed out, but we also have a gold to oil ratio that is around 50 to 1, 50 barrels of oil to 1 ounce of gold. So yes, that sentiment is good for buying. Also, the ratio is at an incredible opportunity or an incredible area to be potentially purchasing because of the valuation of the sector. Coming down, and here's oil. Everybody lines up to buy oil at 120, but at 65, no one's buying. That's just sentiment. That's um, what is ingrained into the genetics of human beings. What you're fighting is exactly what you've learned your entire life. Nobody wants to be alone. Nobody wants to go against the herd. Everybody wants to fit in. Everybody wants to buy the Nike shoes, the Jordans. They want to wear the Gerbeau jeans. You guys used to wear Gerbeau jeans back in the 90s, if you know what I mean there. Everybody wanted to fit in. And it's the same thing. It's like psychologically, they just can't do it. So being a really good investor and buying lows is incredibly difficult because you have to step outside of everyone else and do what they're telling you not to do. They're going to say, don't buy oil. Don't buy oil. A recession's coming. Don't buy oil. Don't, all these different reasons of why you shouldn't buy it, even though it's at a 50 to 1 ratio against gold. Gold's already ripped. For the most part, oil follows gold. Now, could oil go down in the short term? Definitely could. It definitely could. And that's where you need a strategy. You put it all in at once. Do you cost average in? What companies look good from a technical perspective? Maybe you ease into ones that are looking good. Maybe there's some that don't look as good and you don't want to go into those yet. What's your strategy? What are you doing? Cycle investment strategy. The oil COTs are extremely bullish. So the smart money, which is the red commercials at the bottom there, they are positioned at the upper end of the historical range. This level in positioning correlates with bottom formations in the oil price, which is the purple squares here, as you can see, be seen from the past. At the same time, the managed money, green is the dumb money, is positioned historically low, exactly what you want to see before a possible upwards move for oil. Um, I'm going to say this in the oil space, like energy service, exploration, production. There's some crazy deals out there right now. Crazy deals. I don't know if they're as good as they were in 2020 at the bottom of the bottom. Those are ridiculous, but they're pretty close. I mean, they're good. We're talking price to book ratios that are very low, below zero point 0.5 even, and the companies have incredible growth with the oil price. So if the oil price goes back up and we get more towards 80, 90, 100, and we pass all that, which I think we will, then they look absolutely incredible because the free cash flow of those companies are going to go up massively. So do you buy valuation? Do you buy the technical analysis charts? What if you can get a little bit of both? What if you get a short-term bottom and you say, screw it, the valuations are good. I'm going to step in here and take a chance. That's kind of where all the big money's made. Uh, you have to buy it when there's uncertainty in the market and where things aren't certain. And that's what's difficult with most people. They get fearful, the uncertainty goes up, and they can't pull the trigger. Pulling the trigger when there's maximum fear or uncertainty is where all the money, where a lot of money is made. Maybe not all the money, but a lot of money. And it's the strategy that you want to try to figure out. What is the strategy that someone should deploy for maximum returns over a long time frame? And that's kind of what I've been researching this entire time. Who are the people that make all the money as investors? Have they blown up or not? And how are they doing it? And that's kind of what I went over in the on the website on my strategy and kind of how I approach the market. It's very similar to other strategies that haven't blown up that select certain types of companies, and then it's more of a longer term approach than it is a shorter term trading approach. It's not a trading approach, more of an investing approach. And value is what you get, or sorry, value is what you get, price is what you pay. And you're trying to look for a mismatch between the price and the value. The bigger the mismatch, the better the opportunity. But that doesn't necessarily mean that it's going to work out immediately. And it doesn't mean that buying the absolute bottom is possible because we all try to buy the absolute bottom. That's the the whole goal of it. And sometimes you have to ride through volatility as you're trying to get through towards the bottom there. Egon von Greyer says, as many have used conventional technical tools to predict a gold correction, I've been saying for a long time that gold is in an acceleration phase and will reach multiples of the current price. Thus, it's the big long. So gold, and I'm sure silver's in the same case. He calls it thus the big long, and I like the big long too, if you know what I mean. Not that type of big long, but I like the name, the big long for commodities, gold, silver, those types of things. And versus the big short, which was basically a deleveraging event in the real estate market. That's the big short. The big long is commodities, precious metals, and what's coming up there. So I agree. Now, a lot of the technical guys, they're going to tell you all the reasons why you shouldn't be holding gold. You should sell it. It's over. Its RSI is too high. Its MACD is too high. It's overextended. Um, that's not how the big money made their money. They didn't trade in and out. They purchase assets at really cheap prices, and then most of them never sell. They never sell. So let's just say I'll use my father for an example. He was born in 1951. He worked in the 1970s. If he had purchased a whole bunch of gold and a whole bunch of the S&P 500 and he purchased his company stock and just never sold his entire life, he would have done incredibly well. And that's pretty much what he did. Um, so the really rich people, and I'm talking, top 1% above, that's how a lot of them do it. They acquire assets and they just never sell it. They acquire homes and don't sell. They acquire precious metals. They acquire businesses. They acquire stock. They acquire all these things, and then they just don't sell it. They just hold on. The Fed was built to destroy sound money and enslave society. There's no reason for its existence. Hey, I can get behind that. The next Federal Reserve chair must rebuild what's been lost, restoring the monetary integrity of the United States. I'm with the first quote there. The Fed is built to destroy sound money and enslave the society. Totally agree with it. There's few societies that didn't have Federal Reserve banks. Some of them were incredibly successful, and they were wiped off the face of the earth because they didn't want you to know how successful those countries are without a Federal Reserve Bank. Coming down, we've got investment wisdom. Only buy something that you'd be perfectly happy to hold if the market shuts down for 10 years. And that's that buy value and just don't worry about it and don't sell. And that's Warren Buffett. That's what rich people do too. It's all very similar. Now, Patrick says, and he's got a very different viewpoint from maybe what I think. He says low risk entries are never found at lows, but they are. It depends on how you're looking at it. From a technical analysis perspective, where you don't know the company and what the companies and fundamentals are, then yes, you're going to have to do something different. But in my opinion, that strategy is not a winning strategy. My strategy, I would much rather buy value. I'd much rather try to buy closer to the lows, even if I have to ride down a 15, 30, 40% drawdown. Because if you're waiting to break some, let's say, some horizontal resistance, you're never going to beat that strategy. You're too far behind it. And it all depends on what you define as risk. So is it better to buy a company that has broken out more towards its highs or all-time highs, but is absolutely undeniably overvalued to the hilt? Or is it better to buy something that's really close to its lows, but absolutely and incredibly undervalued? And let's say it's close to some falling wedge at a bottom or something. The fundamentals are incredibly cheap, and you've got a commodity. Let's say it's a commodity company, and the commodity is incredibly cheap against gold and all these other things. It doesn't mean that it will immediately go up, but I would say that that's a less risky entry point than chasing something that's broken out, that is completely and utterly overvalued, that has absolutely no earnings and could blow up at any second. So, understanding the company and what the company does is your risk. It's part of the risk. It's not the only thing. Your risk is your commodity price, the the commodity coming into favor in a good market condition, and then buying a company that you're not overpaying for at the same time. Your risk is not knowing what the heck the company's valuations are and then buying it solely based off of technical analysis. So I differ on that, and I can understand and be empathetic to his position of buying something that's got a little bit of momentum, upward momentum behind it, breaking some resistance lines. That makes sense from a certain perspective, but I don't think you'll beat the strategy of buying undervaluation at market cycle bottoms. I don't think you can beat it. I don't think anyone's beat it. Another way that you could back test this is who's made all the money in the markets. Who are the rich people that don't blow up, that consistently do well in the markets, and they all kind of follow the same strategy, and that's to buy undervaluation. It's not about buying a breakout or buying something where you're breaking some technical pattern, but you know nothing about the company. And I'm not putting these guys down by any means. I just don't see the technical analysis guys. Like, I don't even think that strategy can work if you get enough money, let's say like billions and billions of dollars, I don't think you can adopt that strategy. I think you almost have to go with the valuation approach. But that's my opinion. This time is different. The stock market has fallen 10% or more 37 times since 1950. Every time it feels like it could be the big one. Every time the market recovers. Every single time. So the way that the takeaway from this is to adopt a longer term approach to the markets. But I do think that there are some large differences between some of these eras. This was a declining interest rate environment from 1982, which is here onward. Declining interest rate environment. We're in an increasing interest rate environment. We could go sideways for a while because of the overvaluation in some of the stocks out there, particularly like S&P 500 and the NASDAQ. So I'm more in the commodities camp just because of the undervaluation. But that doesn't mean that it can't go higher. It doesn't mean that inflation won't push it up and kind of hide the underperformance for maybe a little bit, is my guess what could happen. But everybody gets so afraid of losing money. Everyone. And I see in the comment section of all these, there's comments in here, there's comments in this one here. What if you get a 10 or 15% pullback? It's like, well, that's all part of the game. If you're trying to buy lows and you are successful at buying in certain areas that are incredibly low that yield 10, 20, 30 times your money, um, most of the time you're going to have to buy pretty close to the lows to get that type of return. And it's going to require patience. It's going to require um, up and down movements, volatility at that bottom. You might be down in the stock 20, 30, 40%. Maybe your strategy is to cost average in and get a good chunk of a position over a period of time. You don't have to go all in at once. You don't have to try to time the purchase exactly perfect. And I don't think you can. I don't think you can. So, what strategy is going to prevent you from getting smoked if you don't have timing? But what is the definition of smoked? Smoked means that you lose your position and you just lose it completely. It's not 30, 40, 50% up and down movement. So the stock could be down, 60% from its highs. Let's do 61.8% from its let's say not from its all-time high or from a high that it recently made. Let's say it's a wave one high. It pulls back and you start to accumulate. I mean, that's not a bad approach. And yeah, it could go down more, but still, I don't think it would be that bad if you know that you're coming into cycle. Markets and Mayhem says, wow, international developed markets stocks are outperforming the Mag 7 by 27% year to date. So Mag 7, small cap, mid cap, S&P, they're all down year to date. And the ones that are up, emerging markets and international developed stocks, this is kind of where I'm located. I'm located more over here, and I'm also located in stuff that is down, like oil. But some things are up. I like precious metals. I like the precious metals mining companies. They've done pretty well this year. But I don't. My goal isn't to have 100% all up years. My goal is to maximize my total return over the bull market of the commodity precious metal bull market we have entered. That is my goal. It's not having up quarters every quarter. That's not my goal. It's to maximize the total return of the portfolio, and make sure that I capture those big upside moves with companies that I think have a high probability of following the move. So, I mean, a lot of people look at this, oh, year to date, oh, I need to do this and I need to shift this. It's like, oh, I don't play that way. I just accumulate companies that are cheap and that are down. And then I wait for them to go back up. And that's generally been a really good strategy. Your holding periods in the beginning before it goes up, if you're buying the bottoms, could be 6 months to 2 years. It could even go longer than that, depending on the sector that you get into and kind of what the market is doing. But it might take a couple years for it to really turn around and get moving. Tracy says U.S. jet fuel demand soared to its highest seasonal level on record last week. The 4 week average of products supplied, a proxy for demand, is up nearly 12% since the start of April and is now 150,000 barrels a day higher than the last record set in 2019. So look at 2025 here. That's straight vertical there in April. A very big move. And this is 2 million barrels per day at the top, a little bit over 1.8. And that is a high, an all-time high versus, I mean, look at how far down. This is pretty big demand if you look at this. Look at the April of 2021. We were at like 1.25, 1.3 million here, and we're all the way up over 1.8, 1.85, 1.85 or so. That's a big move from a couple years ago. I mean, that's quite substantial there. That's a good chunk of demand. The FI couple or Florida couple, I thought it was, but what does it mean to be rich in the United States? The top 1% has an 11.6 million net worth. Top 2% is 2.7 million net worth. Top 5% is 1.17 million net worth. Top 10% is 970,900 net worth. Do these numbers surprise you? No, not really. I mean, I would think that top 1% would be like 10 million. That would be my guess. Top 2%, as you get away from the 1%, it really starts to drop. So yeah, it makes sense. Top 5%, 1 or 2 million bucks is probably what I would have guessed if I were to just throw a random guess out there. But yeah, that's not too bad. I mean, here's the thing, guys. I mean, this if let's just break it down, all right? What's the difference between these guys here, like the 1 or 2 million range, and someone who's got like 10 million bucks? I don't think there's that big of a difference. Um, a guy who owes $10 million, he doesn't own his own jet. He doesn't, he's not going to be living the most extravagant lifestyle. He's probably in a house that's 500,000 to 1.5 million. And that house is not going to be much different than the house that these people live in. The car that that person drives is not going to be much different than the car that these people drive. So I don't think, in order for you to have like a large step change in lifestyle, you got to get your money way up there. Like, let's say you're going to buy a few $1 million house, you're going to have people cook food for you. You're going to have a jet where you don't even have to interact with anybody. You just go to your private jet and fly. That is way more than 11.6 million net worth. So you're going to have to be in the top, point something percent to be milking it like that. So when I look at this and people are like, well, I'd buy a Lamborghini. It's like, guys, a Lamborghini isn't. You can replicate a Lamborghini. I'm not saying I'm more into the performance aspect versus, say, the name or title or brand. So you can have just as much fun in a car that's not nearly as fast if you go take it on a track and have fun in the corners and braking and all that stuff. I love that. You can have fun in slow cars, you can have fun in fast cars. You don't need to spend a ton of money to have fun. And all this money is going to do is it's just going to amplify who you already are. If you're pissed off and not happy, then you're probably just going to be pissed off and not happy with more money. It depends what's pissing you off, I guess. What money does, it amplifies whoever you are. If you are already content, you're pretty happy with your life, it's not really going to do much. If you're unhappy because of a certain reason, maybe you can change that circumstance with money, maybe not. If you don't have health, well, then money's not going to do anything for you. And most people will trade money for youth. So if you are young and you don't have money and you want to be old and have money, well, just realize that the old people who have money want to be you. So think of it as how you can have fun being young. So I don't know. I don't think the best thing for me, at least I think the best thing for most people is to maybe do a job that you don't maybe have to do or do a job where you like doing it. I think that's probably the biggest bang for the buck. I don't know if sitting there and doing nothing is going to be really fun, doing nothing all day, every day. But yeah, money just unlocks, it gives you opportunities where you don't have to do things. You don't get into a bind. That's all a lot of that is used for. If you've got a unexpected expense, no big deal. If your boss is treating you like total garbage, see ya, I've got the FU money. I mean, that's really what it is. Cycle investment strategy. Oh, this is another one on crude oil sentiment. We already went over that one. Skip it. The game of investing is one of making better predictions about the future than other people. How are you going to do that? One way is to limit your tries to area of competence. If you try to predict the future of everything, you attempt too much. Yeah, so what he's saying is focus in on what you're good at. And then if you're going to look at the future and see things differently than the market, that's where your investment opportunity is. So everything is based off of the future. So when people look at data, that's already priced into the market if it's out there, and people are all looking at it. Uh, they're thinking of what's coming, not what necessarily is. Now, that perception of what they think is coming is what you are betting against. You are betting against what the market thinks is coming, and then you might say, nope, what they think is coming isn't going to come. So, for instance, let's just give an example. We're talking about oil, and oil has got this real negative sentiment. So, someone could say, well, you know what? I think this is overdone. I think the market is too negative on oil, so I'm going to take a position in oil. Another thing is what you could take is say, you know what? The market is right, the sentiment is right, and demand will get killed with, say, the tariffs coming in, and we're going to get a recession, and I want to position that way. Now, it doesn't matter what data you can scavenge up and what argument you can make. What matters is what is the market already priced in, and what is the next 12 to 18 months actually going to bear in terms of, bear fruit, or is it going to be larger demand, and is the market priced that incorrectly? If it's priced incorrectly, then price goes up. Priced incorrectly in the opposite side, then price goes down still. But usually when everybody sells something and sentiment is this low, generally that's a pretty good time to be looking. Distillate market getting very tight. We're still riding the low end of this 5-year average. That's generally been pretty bullish. I mean, product is going out the door, so to speak. Now, here's the thing. If you were to ask people, they're probably going to say, well, you know what? Shipments for a lot of this stuff that's coming is not coming. They think that it's going to slow down because of the tariffs, and that very well could be the case. We could see um, shipments coming from boats slow down, and then that's going to have an impact on trucking, which just kind of blows out all through the whole supply chain. So that's kind of the bear case, if I were to make a bear case. And that's all I've got for today, guys. So that's what I've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. And we'll catch you guys later. This is Finding Value.